on, there's somewhat a valuation divide in the market, the way I am taking this and understanding this thing. If you look at banks, there are public sector banks that have had a better recovery after the COVID pandemic. Their profitability is improving. They are growing compared to their private peers, yet the valuations are somewhat confusing. So why are PSBs not valued as much as the private sector banks are?
So, Pragati, one of the research that we've done is actually India is a very, very good and a shining star for the world, right? If you look at the last 15 years, globally banks have lost about 2/3 of their valuation, right? Their PYBs have come down by 66%. Compared to that, India is actually one of the strongest valued banking industries, and they have had record profitability. Now, when we de-average that, there is still a segment, 45% of the banks in India, which are accounting for 40% of the advances, that are still trading below 1 PYB, which means their cost of equity is also not being returned. And that's where we're saying, there's a lot of capability built, a lot of, governance, a lot of reforms that needs to be taken. And that doesn't always and necessarily have all the public sector banks. I think there is a mix of, different banking components. There are the old private sector banks, there are the RRBs, there is, some of the public sector banks, which need to start becoming, more efficient, more better and capable. And I think that's where we're saying, there are a set of imperatives that we've come out in our report saying, how do they actually look at the next 5-10 years and build the right capabilities.
The valuation bit, I have one clarification that I would like to get. So in general, if we see, if there's a valuation divide, it poses a risk to the banking system. If the PSB's valuation does not catch up, is there a risk to the Indian banking system?
So I'll just frame that slightly different, Pragati. I don't think it's the PSB valuations alone. I think as a whole, whichever are the components that are trading below public PYB of 1, right? And one of the things as we compared different banking industries and economies, right? We're saying banking industries which are actually trading above 1, 1.5, 2, they actually drive the GDP much more, and the banking credit to GDP index that we've seen dramatically increases compared to banking industries where the PYB is actually below 1. So as we think about India and the macroeconomic objective of getting to 30 trillion aspiration by 2047, banks will continue to play a critical role. And till the time we don't pull this segment, which is, trading below the 1, PYB, it will have impacts and consequences on the macroeconomic objective as well.
Okay, so indeed it becomes very imperative for detachment. Good, fair, I got it. Coming back to the climate bit, I was seeing your reports and I have one figure in front of me actually that really struck out when I was looking at it. So global banks are leading in the climate finance, and if we talk about India, it's not that strong yet, if we were to put it in simple terms. There was one very interesting figure in the report that I saw, that even 50% of bank credit is in sectors that are vulnerable to climate risks. So, do you think that this particular area can dampen the positive outlook that is currently present about the Indian banking system?
I don't think it's as much about dampening the spirits. I think it's being more aware about the risks that, entails on this portfolio. I think globally, as we think about it, banks need to start pricing this or start thinking about this in the risk management and the risk mitigation framework, right? There is a large amount of credit that is being given out there, which is right now vulnerable to some of the other natural risk, climate risk that is there. We need to start at least monitoring that in an effective manner. That's one part of the physical risk that exists, right? I think the other part that we articulated in our report is, as we think about the transition risk, 60% of the financing that will be required is to, transition the SMEs out of the, high emission sectors to a low emission sector, right? And as we think about it, corporates will always find a means and wherewithal to actually do this. But banks will play a very critical role as far as, transitioning the SMEs and supporting and becoming the advisor to SMEs as they transition this climate risk.
So it brings us back to the important role that banks play in this entire journey of growth and to sustain those funds. Fair enough. So before I close this conversation, I want to pick the favorite topic of the event, to put it simply, the credit risk weights and the unsecured personal loans. The topic has been around for quite some time actually, but for last 1 year since the RBI made the announcement, it has been a topic over here at the event as well.
Yeah.
I want to understand from you, since you are an expert in the field, how do you see this impacting the banking system apart from the fact that there might be a capital requirement of banks that might increase?
I think the honorable governor and all the banking CEOs actually spoke about it yesterday. If we think about the credit slowdown, I think there was one number around it will be a 50-60 bips capital requirement, about 3-4 bips of pricing adjustment that will be there. But if we think about the broader economy, right, and we've articulated this in our report, there is a sharp decline in the approval rates for banks, right? But if we look at the delinquency ratios, we're actually as good as the pre-COVID period that was there. There is some bit of loan stacking happening in some segments and some ticket sizes, which will have to be which is less than 50K, but that we'll have to be careful about. But overall, I think the sector is doing really well. The delinquencies are not starting to show up, but that is where we're saying, as banks and as an industry, this is the right time to invest in building the new capabilities so that we don't have to face the same situation that we faced 5 years ago, 10 years ago, or 15 years ago on the corporate or the retail side. And that's why we are saying we need to build the right capabilities, invest in the risk management framework, and think about the future ahead.
Okay, just one small clarifier here. Are we seeing a near-term impact or a long-term impact because of this credit risk weight raise at the bank?
On the pricing side, or
on the pricing side.
On the pricing side, there will be some bit of adjustment in the near term, but I think that shouldn't be too much. I think there was one estimate from the CEOs around 5 to 10 bips at best. On the capital requirement, I think 50 to 60 bips at best on the overall banking industry.
That's been the broad consensus.
That's been the broad consensus over there. So we're not seeing that to be a big dampener per se. I think there will be some bit of transition from unsecured segments to other forms of financing, but we'll have to see how that plays out in the industry.
Okay. All right. Thank you so much, sir, for talking to us. This was great, and thanks so much for clarifying so many things for us. It was a pleasure.
Thank you so much, brother. All right. Thank you.